Well, it seems there's a battle going on in global stock markets between the bulls and the bears. We've seen markets reach all-time highs, we've seen them come off a bit, and now there seems to be a bit of a tug of war over which direction the market's going to head. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 4th of June 2024, and before I get started, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So I wanted to start with economic data, and particularly Australian economic data. It's really been quite weak as of late. So over the last week we've seen lower than expected retail sales, worse than expected construction work done, worse than expected building approvals, and today we've seen lower than expected company operating profits for the first quarter. On top of that, our current account deficit has been larger than expected, and basically just about every bit of economic data has come in lower than expected for Australia, except for last Wednesday's monthly CPI reading, or monthly inflation reading. So we've got all this economic data coming in weak, except for inflation, which is still remaining strong. And really it's a perfect storm of data for Australia. It's not what we want to see at all. Arguably stagflationary. Now we will get an update on economic growth for Australia tomorrow with the GDP numbers for the first quarter. But if you remove the very large levels of net overseas migration that we have at the moment, we're actually in a per capita recession at the same time that we have inflation well beyond the RBA's target range. So overall, it's actually a really bad situation for Australia economically, and we're continuing to have to maintain high levels of interest rates just while our underlying economy performs particularly poorly. So it is a really sort of bad situation. Now, on the bearish side of things, you could argue that this really sort of suggests that we should see the Australian market move lower. And on the bullish side of things, you might argue that hopefully we're going to see rate cuts due to this economic weakness, and that'll sort of justify the current high share prices that we're seeing. But overall, on the balance of things, I don't really think that any of this data justifies the current level of Australian share prices. Like I said, company operating profits are down about 2.5% for the first quarter. Does that really justify our share prices being almost 10% higher than they were last year? I don't really think so. So all of this brings us to the rate cut timetable. When will rates be cut? Will that bail markets out? Very hard to say. In general, it seems to be the market's belief that we're going to see US rate cuts start in September, and that this will then flow on to the Australian market. Many in the Australian market now, though, are predicting that the first Australian rate cuts won't come until next year. And so, obviously that's not a great thing for our market at all, especially when you consider just how weak the economic data has been for the past fortnight. I think the reality is, though, that if our inflation does resume falling, the RBA will quickly start to cut rates. Like I said, we're in a per capita recession. All of our economic data has been quite weak. And overall, things aren't really that strong for the Australian economy. So if that final missing piece sort of comes into line, and that is, inflation coming down, I don't think the RBA is going to dawdle too much because, if inflation was in the target range, I suspect they'd be cutting already. So like I said, US expected to cut from September. That expected future rate cut is a bit of a carrot dangling in front of their market, and that's helping them maintain their highs. Historically, however, once the rate cuts have started is when you start to see selling in the market. And we're going to see a bit of a test on that theory this week because the European Central Bank is expected to cut rates this week. European stock markets have been really, really strong over the past few months in the lead up to this expected rate cut. So we'll have to wait and see if that is the sort of turning point where they start to see selling, the point at which the rate cut actually is delivered. ECB rate cut, European rate cut expected this week. US Federal Reserve rate cut expected probably in September, and debate as to whether we're going to see an Australian rate cut this year. Finally, I wanted to touch on iron ore. This beautiful red image that we've got here, but unfortunately it's been red for the price of iron ore as well, with the price falling over the past sort of week and a half. It's really gone below its lows for the past few months. There was additional selling today, and that's dragged down the share prices of Australian iron ore miners. Obviously, it's not a great thing at all, and it really sort of points to the economic picture in China. A lot of people have been saying, oh, all this stimulus measure is going to bring the property sector back on track in China. Prices are going to recover because of demand from the property sector. The outlook is really good. But unfortunately, that's just not what the reality is pointed to. The property sector hasn't recovered. Most economists think that the stimulus won't be enough to buoy the property sector. And outside of property, the demand for iron ore, yes, it's improved, but it's not a huge part of the Chinese steel demand picture. So overall, I don't think this downwards move in iron ore should have been unexpected. And yeah, no guarantee that it's just going to sort of push right back up. This is a period of seasonal weakness for iron ore as well. And it tends to be the case for the next couple of months before a sort of rally into August. So yeah, keep an eye on it. Some of the iron ore companies look quite high in price, for example, Rio Tinto, and no guarantee, like I said, despite a week and a half of selling down, that iron ore prices are just about to rebound anytime soon. So let's have a look at the charts for this week, guys. Let's have a look. This is the S&P 500, the US largest, most broad-based share market index, and we can really see that it reached an all-time high right around 53.40. That was with the Nvidia report, and since then they've been drifting lower. There have been a couple of really odd sessions over the past two sessions, Friday and Monday, where the market was trading lower and then it jumped in the last 20 minutes of trade. So they were in the red on Friday, they jumped in the last 20 minutes to close higher, and again overnight they were in the red and they jumped in the last 20 minutes to close higher. Obviously someone's sort of trying to push the market up or jump into the market really late, but I'm not too convinced that that's going to lead to their market back to the all-time high. In fact, if anything, I suspect they'll hold this potential downtrend line and come back towards the longer-term uptrend, back towards sort of 5,200 index points. That will put them around the longer-term uptrend line that has formed since October last year. And yeah, I would not be surprised at all to see us around that level in the next week or so. For our own market, we've sort of started to form our own potential downtrend line after reaching our own all-time high resistance level. So that's 7,900 is the all-time high resistance. We've been coming off since then. We did start to rebound on Friday last week, displaying incredible strength, but we sort of stalled out today. And with iron ore moving lower and the iron ore miners coming off, it's up to the banks to do the heavy lifting, and they're already extremely expensive, already at their own all-time high levels, and if they are to go any further, it's unlikely to be too much further. So with the iron ore miners coming off, I suspect we will see a continued downwards move on our own market. If we do see further selling, the first target for me would be 7,700, not too far away now, and then if that breaks, back towards 7,600. Like I said, there's going to be the Australian first quarter GDP results tomorrow. That could be a deciding factor over where we head from here. But really, it seems like the tug of war between bulls and bears is still up in the air for anyone to decide. So that's it for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you in the next one.